What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Julius Krein, the editor of American Affairs, which is a quarterly journal of policy and political economy that I have become a voracious consumer of in the last month. I think that American Affairs has served for me the function that I hope a podcast like this serves for you, which is to say that it exposes me to a wide variety of ideas or dilemmas, many of which I may already have an interest in or knowledge of, but which either are presented in a way that cause me to think about them differently or are put together in such a way so that I'm able to actually make meaningful progress in my effort to understand them and the underlying, no pun intended, hidden forces driving the phenomena that I'm grappling with or trying to understand more completely. That's a long-winded way of saying that I love this journal, love it. And if you're a geek like me and you're interested in the deeper socio-political, cultural, and economic issues facing the world, then you should absolutely check it out at AmericanAffairsJournal.org. Now, in terms of today's conversation, it is, as usual, broken into two parts. The first hour of which focuses on issues of political economy, policy, market theory, and the complex intersection of incentives that have driven Western economies, and the American economy in particular, into a state of proletarianization, where we're now ruled by an oligarchy whose insatiable appetite for wealth and power is endangering the very systems of free market capitalism and liberal democracy that this elite claims to uphold. It's an outcome that I think Julius would refer to as capitalism without competence and feudalism without nobility. The second hour of today's conversation is, unsurprisingly, the most satisfying, insofar as we tackle the socio-political and cultural dimensions and manifestations of the problems created by the perversions of what I described earlier as proletarianization, or the conversion of the American economy and political system into a more corrupt, upwardly sclerotic, and extractive system of governance than anything I've experienced in the course of my lifetime. It's a conversation that really helped move the needle in my own understanding of the issues and ideas discussed, and I hope it will do the same for you as well. So if you enjoy today's episode, please take a moment to write us a review on Apple Podcasts and consider becoming a premium subscriber if you haven't already. There's no commitment, you can cancel at any time, and the entire library of Hidden Forces subscriber content going all the way back to episode 1 becomes instantly available to you, including the overtimes, transcripts, and rundowns to this episode and every other episode we've ever done. So without any further ado, please enjoy this week's episode with my guest, Julius Krein. Julius Krein, welcome to Hidden Forces.
Thank you very much. It's a pleasure to be here.
It's great having you on the podcast, Julius. I was telling you that I'm ashamed that I only recently discovered your work. It's absolutely phenomenal. As I was telling you before we started the recording, I seldom get the opportunity to read someone's work that not only grapples with many of the ideas that I've been working through, but which brings an order to them that I've lacked and a perspective that is complementary, and that in so doing really moves the needle on my own understanding. And this is where I find myself in this conversation. So I want to thank you for all the stuff that you've been doing. For those who aren't familiar with you, as I wouldn't have been only, about a month ago, I'd love for you to tell me not only who you are, but what's kind of your 5-minute life story. Who is Julius Krein?
Sure. So I'm originally from South Dakota, and I went to college at Harvard, and then I went into finance, actually right at the time of the financial crisis. My first job in finance was at Blackstone. Not to bring them into any of this, but that was my first position. And then I did a lot of work on frontier and emerging markets. So I wanted to keep doing that. So I ended up joining a smaller kind of family office PE shop, did a lot of work actually in Africa and a bit in the Middle East. ended up going actually to Afghanistan as a subcontractor for the Defense Department, working on economic issues and investment issues there, part of the U.S. effort to do economic development in Afghanistan. That's a whole story in itself. But anyway, I did that for a while and then came back to do a more conventional hedge fund. And around 2015, late 2015, early 2016, ended up starting a blog almost entirely by accident with some other friends, mostly in the financial services industry. At the time, it was Donald Trump and the election. And that blog became wildly popular, actually much to our dismay at the time, because we all thought we would lose our jobs. And anyway, we shut it down. But the experience sort of led me and a few others to want to start something more formal, right under our own names. And that's sort of how American Affairs was born, which launched in February 2017. And, the one sentence description of it would be a quarterly journal of policy and political thought. But our main focus is really political economy interpreted broadly, and the kind of outward valences and philosophical and cultural valences of that political economy as well. And I would say, more specifically, or maybe to give a little bit of its direction and substance, we tend to have internalized kind of the failures of the 1990s and the post-Cold War order, I think, in a way that maybe others haven't. And we've been sort of writing about these and trying to both diagnose the failures of the post-90s sort of era of globalization and the foreign policy issues as well, and also more difficult, offer solutions. And that's what we've been doing for the last 5 years. And I think uniquely among political journals or political publications, we try very hard to stay outside of the conventional partisan frameworks. So we have people from left, right, center, and all over the place contributing to it and reading it, basically around these ideas of where so-called neoliberalism or the post-Cold War order has gone off the rails and where to fix it.
Wow, so much to discuss there, man. You hit on a bunch of topics that I've written out questions for, but let's take it from the top. First of all, what did you study at Harvard?
It's kind of embarrassing because at Harvard, they have a thing called social studies, which is, I would say, it's an interdisciplinary thing. It's kind of the U.S. equivalent of PP&E at Oxford, politics, philosophy, and economics, but it's called social studies. So it's always an embarrassing conversation to say that I majored in social studies and focused a lot on political philosophy.
Right. For people outside the U.S., I don't know what the curriculum is there, but social studies is like 7th grade
Exactly. Yeah.
So how influential was that experience? Actually, before, let me back that up. What made you choose Harvard, and what made you choose that major?
Well, also not especially flattering, perhaps, but the fun story for this is basically when I was, kind of 7th grade or something, there were a lot of biographies coming out about John Adams at the time, David McCullough and others. And I read those and I was really into John Adams, and he went to Harvard. So I thought that would be great to go there. I applied, they accepted me. And social studies, actually, it's one of the few, perhaps the only major at Harvard where you have to apply to get in. And Harvard students like to apply to things and compete with each other. So I basically fell into that. I would say, it worked out well because it did offer a lot of interdisciplinary exposure and maybe a little more well-rounded in terms of subject matter as well as other students compared to just pure government or something like that. But frankly, there wasn't a great design behind it.
That's very interesting that you were naturally attracted to John Adams. Like the founding fathers have had a sort of resurgence in popular interest with Hamilton, I think, with Hamilton's production. Why John Adams? I mean, do you see yourself as an outsider? What was it about his life that resonated with you?
Yeah, I think, there was a part of his sort of career trajectory, largely a self-made individual, largely self-educated, that did resonate with me. He also, I suppose, imagined himself at times as a kind of provincial underdog fighting against London or whatever, which I also appreciated, maybe not entirely consciously at the time. And I really respected the sort of political theory that he put forward, which combined, obviously, the revolutionary elements and impulses with a sort of very strong pragmatism and a sort of, I don't like to use the word conservatism because obviously a very loaded term, but this idea that one had to sort of maintain a government that was capable of strong action, what you might call state capacity in today's terms, that I suppose I'm still very interested in.
Right. A controversial figure, famous for having passed the Alien and Sedition Act. We also, for listeners who are interested, we covered him in our episode with Thomas Ricks on the Greco-Roman influences on America's founders. How influential was that experience at Harvard in guiding your intellectual development, and how much was really guided by your life experience before that, maybe your experience working on Wall Street or actually going to Afghanistan? How would you say that, looking back now, you came to hold the views that you hold today?
Truthfully, I would not say the Harvard experience was especially important, at least in my intellectual formation. Obviously, I met a lot of people, and it was very important in that respect. But it was not nearly as important for me as actual experiences, first really in Afghanistan, and the extraordinary disconnect that I saw there between reality and the way things were discussed in DC and in American politics and political media. Insofar as one talks of people being radicalized or whatever, that was a radicalizing experience, or at least an eye-opening experience for me. And then I would say also my experience in finance on Wall Street really has shaped my thinking about economic policy more than anything. Certainly, having read political theory, it's important, I think, to get you out of what is often called the kind of Whiggish interpretation of history, or the sense that whatever things are now, whatever the status quo is, that's sort of perfect and everything kind of beautifully led up to that. You need to get out of that, and political theory is very important to do it. But one thing I found, particularly on the American right today, is that people tend to grasp for political theory whenever they don't have any access to real power. And it often can be very debilitating. And even, of course, in history, for example, I mean, Machiavelli starts writing his great works when he's kind of pushed out of Florence and on the wrong side of the regime changes there. And I think you could still see that it's very true. And so I've actually done my best to avoid getting too caught up in political theory and to really focus more on practical aspects and practical issues, which I think is more necessary in the present moment.
That's fascinating, man. I never thought of it that way, that those who are out of power grasp for political theory. That really resonates. You also studied under Mansfield, correct?
I did.
He wrote quite a bit on Machiavelli. This is also interesting. I mean, I want to separate it because I'm curious the extent to which you were influenced by ideas and the extent to which you were influenced by experience. Because it sounds like for you, especially since you emphasize the point of practicality, that experience has played a much bigger role. But I'm curious, were there any particular thinkers that have helped inform your views? Because you are really, if I had to describe you, a public intellectual.
Well, I don't know if that's a compliment.
I think, look, it's a compliment insofar as, I don't know, it's certainly not a compliment. I mean, I think you're a very, very, very gifted public communicator. You use language eloquently. I think language skills are underdeveloped in society today. And I loved reading your writing. And I'm one of those people that, while I think that overly technical phraseology is not something that, should be used too much, I tend to gravitate towards it. I enjoy it. So take that how you will, but I enjoy your writing very much.
No, I was joking, of course. I appreciate that.
Yeah.
Well, certainly, one should do political theory when you don't have any connection to or access to real practical things and issues and power, however you want to define it. So certainly in my college years when I was younger, I read the entire political theory canon from the pre-Socratics to Heidegger and Foucault and the postmodernists. I suppose I was always most attracted to maybe Plato and Nietzsche above all.
Fascinating.
And I guess, and my sense is one way to divide the canon is thinkers who really want to unite sort of reason and the more non-rational aspects of life. So someone like Aquinas would fit into that category. And I would say Aristotle in that category. And then there are others who mark a sharper divide between reason and non-reason and are maybe more pessimistic about reason and rationality as being pure virtues or pure goods. And I've probably always gravitated more toward those thinkers, hence Plato, Nietzsche, Rousseau, and that sort of thing.
Well, that's really interesting, though, because, and maybe this is your point, because Plato and Nietzsche were so different in some fundamental ways. I mean, Plato, well, the first thing Plato said in the Republic he would do, or one of the first things he would do, would be to ban all the poets. But Nietzsche really, I think, gravitated towards the tragedians and towards poetry and towards that sort of more romantic element of the human spirit, and emphasized much more, I think, the here and now, this life, as opposed to this idealistic world of forms. Is that what you mean? Because they offered you this duality that you would try and find a way to walk between?
Well, this is a bit of a side note, but much of Nietzsche is actually a commentary on Plato, sometimes explicitly, often implicitly. And I suppose one thing I do have to thank Mansfield and my educational training and really kind of Straussian introduction, Leo Strauss introduction to political philosophy, is to see where Plato actually doesn't fit so nicely into that caricature. And beneath the surface of Plato is actually maybe an attack on some of these things, or at least portraying Socrates. Socrates is not simply a hero in Plato. There's a wonderful commentary on Plato's Gorgias by a man named Seth Benedetti, who was a student of Leo Strauss and takes a lot of his bearings from figures like Nietzsche and so on, in discussing how actually, in the Gorgias, and you can also see this in Nietzsche's Twilight of the Idols, Socrates is very much the real tyrant in the whole thing. And he's trying to beat back his other impulses, his hedonism, by making reason kind of the highest pleasure.
He turns reason into a tyrant. I think that was...
Exactly.
Right. I think that was a line of Nietzsche's.
Yeah, I actually see Plato and Nietzsche maybe not as opposites, but as allies, though they had different styles of writing, with Plato expressing it more esoterically, to use the Straussian term, and Nietzsche being more obvious about it.
Yeah. Yeah, fascinating. I mean, I do think, again, this point about emphasizing the practical, emphasizing lived experience that you've put forward, I think, really resonates with me. But at the same time, I do think it's invaluable to have some type of foundation in philosophy and history, because it really helps you not only to contextualize your ideas, but also to communicate them. I'm going to roll, the Afghanistan part of your experience into this one question, which is that I often talk about the influence that the 9/11 attacks and the Iraq War had on my own political development, because I naturally gravitated in college and in the few years after college towards the progressive wing of the Democratic Party, because that's where all the interesting countercultural ideas were coming out. Writers like Howard Zinn or Noam Chomsky or Chalmers Johnson or John Perkins, some of whom I've seen, John Perkins is back in the media again. People seem to be discovering his work. And then the GFC the Great Financial Crisis, then sort of flipped me in an opposite, more libertarian direction, which I think also speaks to something else that you grapple with, which is the inadequacy of labels of left and right that we deal with. I'm curious what impact the war had on your own development, given the fact that you graduated 4 years after me. I think you graduated in 2008, and as well as what influence the Great Financial Crisis had on that political development of yours.
Right. Yeah, I suppose my youthful flirtation with idealism was a pretty standard neoconservatism. And I say that somewhat tongue-in-cheek, but I, at the time after 9/11, I was sort of very much on board with this. The United States needs to be very active and adventurous, really, in foreign policy. And I largely accepted those arguments. And visiting Afghanistan and just the vast chasm between what we were supposed to, or what we said we were doing, and what we were actually doing, the extraordinary level of incompetence among at least the civilian part of the U.S. military involvement there, which was what I was doing in the economic development sphere, really forced me to rethink a lot of the political positions I held at the time. And with respect to the great financial crisis, I mean, it did not affect me personally all that much, but I think it ended up causing me to begin my financial career in restructuring, which is dealing with distressed and bankrupt companies, which was a good place to be at the time, and maybe gave me just a different look at how companies that were struggling, how they were treated by the financial system, and how actually one could make a lot more money with a failing company than with a successful one. But I would say actually it was later than that, because obviously in 2008, 2009, it was my first professional experience. I was very young, but it was a few years later when I started, regularly speaking with CFOs and CEOs, CIOs, whatever, of S&P 500 companies, where one would hear frequently, it was rarely, if ever, a discussion of this is the next innovation we're pursuing. This is the next, new factory we're building, new expansion we're doing, new product we're going to do. And very frequently it was, here's where we can cut things and send them to China, and then we'll use the proceeds to do share buybacks. And when you hear that over and over again, it becomes kind of, the widespread, most common discussion among the largest companies. It really makes you begin to think about, what is this economy doing? Obviously, whatever Adam Smith is talking about, that's not what we're doing here. And I would say also the Greek debt crisis and the European financial crisis a few years later, and seeing all of that unfold was also very illuminating to me. And it really led me to, for the first time, to seriously study a lot of macroeconomics, beginning with people actually like Yanis Varoufakis, whom, we probably don't overlap a great deal in our political affiliations or whatever. But I was actually very struck by his interpretation of macroeconomics and financial flows in the global Minotaur, describing the US and Greece and all of that. And I was also increasingly struck, having now had a bit of experience in finance, to begin reading some of the leftist economists and authors on financialization and so on, and finding their account actually incredibly accurate. And I was surprised to see that, given that they obviously were not practitioners, were not in the financial industry, but I found their discussions actually far more accurate than the, kind of classical economists or neoclassical economists and so on.
Another person I failed to mention, who I read so many people in those years near the end of college and shortly thereafter, who influenced my thinking in exactly the direction that you're describing. One of them was Kevin Phillips. He'd written a number of books. I think the first book he had written was back in 1969, which was called The Emerging Republican Majority. But he wrote a book called American Theocracy that I read shortly out of college. And then he wrote another book subsequently that delved more into the economic aspects of that book called Bad Money, which focused very much on the policy decisions that were made. And I actually had an opportunity to meet Kevin. I had him on my old TV show, I should mention. He wrote another book called 1775, which was about the year before the revolution, also a fascinating book. But what's interesting is he spends so much time analyzing, and it's the progressive economists really that I discovered who did this, analyzing the specific policy choices that were made that have led to the economic outcomes that we have today. And it's interesting to see. I imagine also you're probably a fan of Michael Pettis' work, who we've also had on the podcast, and you've shown interest in sectoral balances. Do you feel like a lot of this type of work, this canon of economic theory that was largely or has largely been ignored by mainstream conservatism, is now entering this new emerging consensus, political consensus, where you've got people from the left and the right agreeing on some core practical views of what has happened to the American economy?
It certainly is among people who are serious about economics and economic policy. You definitely see that. And, I won't name any names, but I also hear from a lot of Republican staffers and so on who read, for example, Mariana Mazzucato and that sort of tradition around industrial policy and how the government investment can be critical for economic growth. So there is a much wider conversation and a much wider group of influences that have broken through, especially among the right, I would say. Unfortunately, it's still, I would say, very confined to a small group of people that are really serious about these issues and hasn't really entered the larger public discourse at the moment.
Yeah, a lot of the folks over at INET, I think, intersect with these ideas. Another, again, I'm shamelessly plugging guests that have been on this podcast, Julius, only because the work and the conversation we're going to have today pulls from so many of these different people, or at least I pull from them because they've really helped open my eyes to a lot of ideas that I had been closed off to. And one of them is Bill Janeway. He wrote a book called Doing Capitalism in the Innovation Economy. Also a fascinating book, very similar to Maria Mazzucato's book before her most recent one, and dealing with really the role of the state in the early stages of the innovation cycle. I think that was like episode 63. You mentioned the European debt crisis. I'm curious to hear more about why that was so meaningful to you.
Again, as I mentioned, it was the first time I had really encountered a lot of these strain of macroeconomic thought, because as a pure financial analyst, you don't really need to do that often when you're just looking at company 10Ks. And I would say the financial industry as a whole probably tends to underappreciate macroeconomics. But in the Greek case, one had to read it for no other reason than Varoufakis was the finance minister of Greece at the time, and people were trying to figure out what he was going to do. But more generally, it also, as you begin looking into this, it also exposes the extent to which the private sector and the government are rarely, if ever, opposites, as conservative politics especially, and maybe neoclassical economics more generally tends to think of them. You know, you have the government sector over here and the private sector over here. And in those traditions, of course, the government sector is usually responsible for bad things and causes nothing but problems. But once you begin unraveling these economies like Greece and dealing with situations where you had this kind of cycle between the banks and the government debt and the interplay between that as one went down, you know, another that would impact the bank's solvency and so forth, and being forced to explore that and also just trying to unravel the international financial system and banking system, which of course after 2008 had become really entangled and really dependent on the Fed and swap lines and so on. And I don't know if you've had Adam Tooze on. I think you have. Yeah, I think I remember listening
twice,
to that one.
Actually.
Yeah. So anyway, I didn't have a great degree of personal practical experience in those issues, but it was actually very intellectually illuminating in bringing a lot of these larger issues to my attention in a way that hadn't been done before.
Yeah, one of the reasons that I think the primary reason why I brought this up is because I actually thought about this comparison when reading your work, which is that there seems to be a similarity between the disconnect of German voters who support national policies that strengthen the competitiveness of German products, as well as the, I guess, in a way, devaluation of the mark, of the Deutschmark as a result of the entry into the European Union, while simultaneously decrying the insolvency of peripheral debtors whom they lend their surplus capital to, and the similarities between that and the disconnect of relatively wealthy boomers who want and expect or need, in some cases, 4%, 5%, 7% on their savings accounts, but at the same time don't recognize that the equity valuations that they have in their portfolios are connected directly to their inability to achieve a, higher than near zero interest rate on that capital. That we're sort of caught in this situation as a result of policy choices that has also created a set of embedded expectations that are simply unrealistic. And that's something that we're definitely going to talk about. But rather than sort of jump right to that observation, maybe this is a good time to actually just begin the conversation around the economy by asking a simple question, which is, how would you describe what has happened to the American economy, maybe even to Western economies, over the last 3 or 4 decades that people are increasingly feeling and in many cases expressing through the ballot box? What is the story that you would tell?
Right. Yes. First of all, the connection between the the Germans and the American boomer savers is one I hadn't thought of before, and that's very interesting. But look, in terms of what has happened in the US economy, I mean, in one word, it's deindustrialization. And, in a way, I've come to think of production not so much simply as manufacturing, but the way in which intellectual property or ideas or innovations actually spread throughout an economy and connect larger groups of people together in the benefits and so on. And so deindustrialization has been particularly damaging, the most damaging phenomenon, in my view, precisely because not only have you lost capacity on certain critical, or I should say this, deindustrialization connects the loss of capacity around, national security issues and critical technologies to issues around income inequality and deaths of despair and all the issues that stem from that, as well as slowing growth and productivity. So deindustrialization, and that is closely linked with disinvestment or lower investment. And that's what I attempted to really explain in my most recent article, The Value of Nothing, was sort of the motivations or the causes that have led to that over the last 30 years, namely the ability of companies in the private sector and finance generally to actually increase their valuation through lower growth, or at least independent of growth, and reducing investment. And so that's, I guess, kind of my starting point into this. And then, of course, one can go into many different issues closely connected to that, particularly with how this is interacted with China and the East Asian development model.
Yeah, fascinating. So one thing I also want to bring up that I really enjoyed in your writing, it speaks to the power of ideas and the disconnect between theory and its actual effects in real life. And we see this problem everywhere, whether it's academics musing about what's going on in the economy, or actually policymakers who are looking at models and making decisions based on what they think the relationships are supposed to be, but in fact missing the entire picture. And to that point, the sort of theoretical link that exists between capital markets and the economy feels very broken, to your point. And in fact, you talk about this, the disconnect between asset prices, or the valuations of equities, for example, and actual economic value that's being created by the corporations. What is that story, and what kind of data do we have that we can rely on to inform our picture on this?
Yes, to some extent, all I really was trying to do in that piece is sort of connect two traditions of academic literature in a certain way. Those of us in the finance world or around the investment world have probably read one sort of tradition. And I'm thinking here of people like Jeremy Siegel at Wharton and Jay Ritter. And what this is about is basically it demonstrates that companies that are the most successful in terms of financial returns and stock market returns are the companies that tend to invest less. So the quintessential example of Jeremy Siegel is that the best performing stock of the 20th century, basically, when you include dividend reinvestment, is Philip Morris, the tobacco company. And I have nothing against tobacco companies, I guess, at least no more than anyone else does. But certainly they were not responsible for the big innovations that drove the so-called American century. Companies like Ford and GM and IBM and Boeing and all of that we associate with real growth and real innovation. They were not the top returning companies of this period. And Siegel goes into all this and explains all this and explains how, investment in growth and innovation actually rarely pays for the investor. So that's one sort of tradition of academic literature, perfectly respected, but apparently never, read only by finance people, and apparently never read by, standard economists, where they're still reciting, basically an Adam Smith style argument that companies grow by, you take savings and you invest it and you do new products or whatever, and you grow your revenues and so on, and assume that this correlates perfectly with stock market returns and performance. So I didn't discover anything new here, but it had been a source of confusion for me or interest for me for several years, being exposed to both these sides of literature that no one had ever really put them together, because obviously if Siegel's data is right, then whatever neoclassical economics says or conventional economics says can also be true at the same time, or at least not in the way that it thinks it is. So that's kind of what I was trying to explain there.
So how out of step is the current relationship between valuations and actual economic value or economic growth or sustainable economic growth, the allocation of capital productively in the economy? How out of step is that with historical norms?
Well, I don't know if I would put it that way, certainly because I don't know that there is a natural kind of relationship that one could identify as the standard or, the thing you need to aspire to. What I think, is very clear, very stark demonstration of things being out of step or the changes that have occurred can be found in the work of Herman Mark Schwartz, who's an economist at the University of Virginia, and we've published a couple essays by him. And his argument, which I think is very compelling, is around the shift that occurred from the sort of the old Fordist economy and the new neoliberal economy. And the differences in Fordism, the most profitable companies were also the biggest investors and capital spenders, and also had very large labor forces. So your classic Fordist companies like Ford and big integrated industrial companies. And what happened, some point in the 70s, 80s, this begins, and then it only continues to accelerate, is the most profitable companies under neoliberalism actually are the ones that are able to shed production, reduce employees, reduce internal need and opportunity for reinvestment. And that's sort of what we have today. So one can't simply go back to the 50s or whatever. That's not what I'm arguing. But understanding the shift that has occurred and what that has meant both in terms of stock market performance and underlying economic performance, whether that's GDP growth or productivity and so on. Once you disconnect sort of investment in production from growth, you end up with a very different relationship. And at the very least, economists and policymakers need to update how they understand what's happening. And in my opinion, at least, that has not occurred.
Yeah, that's actually a great comparison, because Ford was one of the first industrialists, if not the first, certainly the first in terms of his scale, to really give the banks a run for their money in his ability to reinvest from profits, as opposed to having to depend on creditors to finance growth, which is so different, right, than what we find today. What do you think is driving this phenomenon? I can actually break that down more specifically if that's too broad a question, because one of the possible ways to break it down is how much is driven by policy choices and how much is driven by structural market-based changes to the competitive landscape driven by either technologies, the sort of software is eating the world phenomenon, highlighted or written about by Andreessen, and how much by practices that naturally favor capital over labor because of scaling efficiencies or because of some implementation of a business model. And by the way, feel free to throw, ideas in there as well, because a lot of these ideas that came out of universities like Harvard, for example, theories, have influenced share buybacks, capital gains, income taxes, et cetera.
Yeah, I was going to try to break it down sort of into three categories of causes, if you will. There's the kind of underlying financial incentives, and I don't think those have really changed in themselves so much. It was just as true in 1950 or whatever, that if you could isolate a pure intellectual property rent, that would be likely to get a higher valuation and be seen as more valuable and a more desirable asset than a very highly cyclical, capital intensive manufacturing facility or whatever. So that I think has always been there. But
elements of Nikefication.
That underlying financial valuation incentive has always been there. But I think there have been technological and policy changes that have made it to become far more widespread and really kind of the driving force of at least the large cap S&P 500 financial economy in a way that wasn't true in the past. So, I mean, part of it is simply, the greater ability to disaggregate things, whether that's because of advances in trade and container shipping and all of that, or IT and computers, which just allow better coordination across multiple firms, multiple places, and all of that. So I think that's one factor. And then you also had a lot of policy choices. I think I would sort of, in part, I would describe a lot of this, or maybe the big impulse behind it is kind of the response to when the rest of the world began to catch up with the United States and kind of recover from the devastation of World War II and had rebuilt their industries largely through industrial policy, often with the support of the United States in various ways. But all of a sudden in the 60s, especially the 70s, you have German, Japanese firms and elsewhere becoming much more competitive and really beginning to threaten the Fordist US model prevailing at the time. And one could spend many podcasts on that. So I'll, simplify it, leave it there. But the response of the US, I think, was really to kind of double down on changing the management incentives to the neoliberal model, which is reducing worker and employee power, empowering financial activists and shareholders to really discipline companies and make them much more efficient. And that, in turn, as time goes on, really pushes Nikification, as I describe in the article, the sort of disaggregation of production from the intellectual property rent. And then as you move into the late 90s and 2000s, the changes in trade policy, the embrace of China in the WTO, NAFTA, and so on, makes it much easier to do this kind of outsourcing and offshoring into lower cost areas, shift even further to contract manufacturing, push employees into, kind of third party arrangements, disaggregate supply chains, for example, in the auto industry. Anyway, all these changes occur, a combination of both technology and policy choices. And the other one I would add, this is maybe reflecting my own personal experience, and one that I don't think is talked about as much, is actually just the development of things like Microsoft Excel. And all of a sudden, you can calculate a DCF instantly all the time. And every financial analyst everywhere is doing the exact same thing. And so anyway, I think this is what took this underlying, just reality of financial metrics and financial valuation and caused it to drive the entire economy toward the, for lack of a better word, we'll just call it the neoliberal model or the Nikification model that we have today.
Yeah. For anyone listening, DCF is discounted cash flows. The thing that, just listening to you, I'm reminded of what makes this subject so difficult for everyone to grasp. And I include myself there because it's so complicated. And when you try to actually deal with the nuance of it, you're confronted with, I think, one of the rationales for why people often cling to theories, because they simplify everything, right? And to that point, so one thing I just want to emphasize is what you clarified there in your answer is that you can't just say, well, it's policy choices or it's the market sort of naturally migrating towards certain types of business models or it's financial theories. It's everything. All of these things are interconnected. I do want to ask you, though, about the role of theory here as part of this larger conversation about what I think we could broadly, in some ways, label as the financialization of the American economy. Because I think so much of this is, again, what we choose to target, right? So I just wonder, in your reading, how influential have theories like shareholder theory or agency theory or dividend irrelevance theory, things, again, for listeners, a really phenomenal episode I recommend is our conversation with Daniel Paris. I think that was episode 73, where we talked about the history of financial theory and its influence on the structure of the American economy. How important are intellectual frameworks in driving this phenomenon?
Well, there's sort of two questions there. One is how important was it for me in formulating my thought? And two, how important were they in actually motivating policymakers or executives and so on? On the first one, I would say that in the case of a lot of these financialization discussions or shareholder primacy, I started from something that I saw in practical experience and found it, somewhat perplexing or challenging, or, it seemed off to me that if every company is just offshoring to China and doing share buybacks and no one's taking this and really reinvesting it at the same scale, that can't be right.
Something's broken.
Yeah, something's broken. And it was after I was trying to figure that out that I discovered some of the financialization theory. And there's a range there. I mean, I think a lot of the conventional financialization discussion is a little bit too simplified. I mean, it's certainly the case that there is an value extractive issue going on where companies are sort of wearing down their asset base and pulling cash out for shareholders. But it's often not as simplistic as, oh, there's too many shareholder activists and they're pulling too much cash out. And that's what I tried to sort of go into in the value of nothing piece, is that there's actually a much deeper set of incentives. And we'll be publishing actually another piece by Herman Mark Schwartz in our next issue, if I can plug that one, that discusses kind of where that sort of simple extractive framework, what it gets right and what it gets wrong, and discussing, for example, the US economy by a lot of measures is not more financialized than much of the world that has had more investment. So there's a lot of issues there, but that's kind of what led me into it. I would say one area where the theory and the writing has been especially important for me is in antitrust and monopolization or competitive policy discussions. I know you've had Matt Stoller on the podcast a few times. He's written for us. I think there have been, that's one where, Robert Bork's book on the antitrust paradox pretty much changed US policy, at least in the judicial system, seemingly overnight. And more recently, we've had a much deeper and I think better rethinking of that, led by people like Matt Stoller and Lena Khan and others. So I think that's all kind of wrapped up in this too. We haven't talked about it, but I think that's very important. Yeah, I guess my sense of it is that, not to sound too materialist or whatever, but I often find the kind of materialist analysis to be the better guide, even if it's not entirely accurate, which is that people, they have an interest in something. It's clear that you can make money doing something, whether it's offshoring or monopolization or whatever. And then there's always kind of theories out there and people search around for them or, actually pay to produce them, as has happened a lot with US economic policy thinking. And then, that is used not simply as marketing material, but I think that's what tends to elevate. I guess I would say that's
beliefs
what tends
come first, strategic reasoning second.
Well, I would say interests come first and then beliefs are found to justify them. And at least in terms of what tends to win out, I'm kind of inclined to believe that, interests and drive adoption of the theory that explains them.
So let's go to this, focus in on something that you mentioned, which is the phenomenon of value extraction, which you discuss in, like you said in your piece, The Value of Nothing, which I, again, strongly recommend. And feel free to plug away, Julius, because you guys are doing really great work. Let's talk about that. Explain to my listeners how the U.S. economy has moved from being more value additive along the continuum towards being more value extractive. And what are some examples of this at work?
Right.
And then I'd like to get into why, how, what are the mechanics that have tangibly led us down this path?
Yeah. Well, to address the first point, I think maybe the simplest way to do it is if you look at these sort of sectoral balances again, and you have the corporate sector and the government and households. And in the traditional model, households save and they lend to firms to invest, and governments are, flat or neutral. But of course, what has happened in the last 30, 40, 50 years especially is that the corporate sector is a net saver. And especially in the US, where you're running a large trade deficit, in part because the corporate sector is not actually investing, you have two ways to balance that. You can either have the households be net spenders, which is what we sort of had in 2005, 2006, 2007. Obviously, that ends very badly because households can't print their own money. Or you can have the government basically pick up the slack and become the issuer of debt. So that, in one sentence, that's kind of the symptom of the value extraction push. To get into...
Flesh that out a bit more, because I didn't follow how that leads to value extraction.
Well, the value extraction simply comes in as opposed to the corporate sector being a net investor. It is a net lender.
Got it.
And you see that another statistic is basically that S&P 500 companies are pulling more cash out through share buybacks and cash returns and distributing them to investors than they are putting in in terms of capital expenditures or R&D. And obviously, two things have to happen. Either that limited investment is so productive that you can actually just invest less. And of course, that has not happened. We have not had great productivity in this country for a long time. And globally, it's not particularly great either. Or you end up just eroding your asset base. And that's actually what we have been doing. And people come up with a lot of excuses and try to hide that and say, oh, well, we're moving to intangibles and this and that. But that, of course, leads to other issues, which we can discuss. But I'll stop there and see if that was helpful.
Yeah, well, I think one really good example is to compare a company like Skype, which effectively sells, or, when it was the dominant VoIP service, it effectively sold VoIP subscriptions, the ability to make a phone call over the internet, and compare that business and the way in which the profits and the valuation were distributed to shareholders, to early investors, et cetera, and compare that to an MSO laying fiber optic cable that actually builds the network upon which Skype is able to offer its product. And try and extract from that, on the one hand, the sort of software is eating the world argument, and on the other, one that you put forward, which is actually what we've seen with a lot of these companies, is not so much, yes, there's a technological innovation, but the technological innovation doesn't really justify the valuation. It doesn't justify the relationship between profits and shareholders, et cetera. It's actually the nature of the business model and the nature of the way in which profits are redistributed that really accounts for it. Is that a good example? Maybe you can actually explain it a little bit better than I have.
Yeah, and the phenomenon is actually much wider than that. I mean, in essence, the entire internet technologies really benefit from a sort of extraordinary, I don't know if arbitrage is not the right word, but a sort of mismatch between who extracts profits and who actually needs to put in the fundamental investment to allow these technologies to work. And it was accidental, but obviously, Google, for the most part, they had a little experiment with Google Fiber for a while, but Google is not actually building the telecom network that allows you to watch videos on YouTube and allows Google to extract advertising revenue. Google is not actually even really making the content. Other media or individual are doing that. So the fact that Google is able to, and the other internet companies are able to extract profits from something without having to invest in the core infrastructure and the core physical elements that allow this to work is precisely the disconnect that has allowed this kind of transition away, or, is emblematic of the transition away from a kind of integrated Fordist model where, one could imagine if Google is a Fordist company, it's actually building out the network, or at least paying something to the network, to a situation where it does not have to make those investments and yet is able to profit from it.
Actually, a really great example of that, speaking to the point about sort of vertical integration versus horizontal and efficiencies versus real value additive versus extraction, is Uber. Uber disaggregated the traditional limo taxi model and lost a lot of the efficiencies of scale that came with that model and didn't really replace them with much. But the business model was highly extractive for certain people at the company, not necessarily the early investors whose investments were used to subsidize the rapid growth of the company. But would that be a good example?
Yeah, and there's a lot of, I don't know if you've seen it, but American Affairs a couple of years ago, I think, published an article on Uber's Path of Destruction, I think is the title. No, I didn't.
Who was the author?
The author is Hubert Horan.
I had Hubert on the show. So Hubert was like one of the very first episodes of the show. It didn't have an episode number. It was a quote, market forces segment. But yeah, Hubert Horan's done great work on this.
Yeah. So Uber is actually emblematic of a lot of this stuff because if anything, Uber has probably decreased some productivities and led to inefficiencies in the sector precisely because there's not really any economies of scale anymore with people buying, taxi companies buying cars or whatever. And at the same time, its business model is based on both, one, you have some regulatory arbitrage where, you're no longer regulated as traditional taxi companies. Two, you had a major push by the venture capitalists behind Uber to essentially create a monopoly and, a conscious strategy to sort of use monopoly power, which, is probably not realizable and hasn't been realized, and so on. And then three, of course, the way that Uber actually makes money is not by really investing into any of the underlying taxi service or whatever, but simply by charging a rent on its software, which, in the past would not have been a profit center, but now it has to be. And you see actually the same thing, I think, with a lot of the payments technology, which is a very hot area. Payment processing begins, I think it's part of like a co-op with Bank of America or within Bank of America to launch credit cards. And I don't think anyone really thought they were going to make money off the actual processing. It was just something you needed to do to make the credit cards viable. But then somebody discovered, you could spin this out. And because it's basically a pure kind of rent, it's not capital intensive, you don't need a lot of employees to do it, this would get a phenomenal valuation. So not only does that lead to your conventional payment processing companies, which are, very large and successful today, but this whole suite of, Stripe and Square and seemingly endless number of venture capital backed payment companies that, are they innovative? Sure. But is any of this really groundbreaking innovation that's improving productivity? I don't think so. It's hard to see it, hard to imagine that happening. But because you have this kind of very pure, little intellectual rent or tax that you could impose on everything going through it, it's not only very profitable, but generates an extremely high margin in terms of stock market valuations, because it's the most attractive financial asset without really marginal costs or big capital expenditures or employees and so on.
So, Julius, I'm going to move the second hour of our conversation to the overtime. There is so much to talk about that I don't even know if we can get through a quarter of this rundown. I want to flesh out what we mentioned earlier in terms of Nikification and that this perverse relationship between cash flows and hurdle rates, which you write so eloquently about. I also want to revisit the point I made very early on in comparing the German economy or the dynamic between Germany and the core and the periphery and shareholders and interest rates, because I think it's a really interesting one that people don't really talk about. I also want to talk about the sociopolitical aspects of this story, because again, you write about this as well, very eloquently, whether it's the generational dynamics, the demographic component of it, and the, as I call them, the boomer block, sort of Shakespearean boomers blocking the path to power of millennials, and how that manifests in all sorts of ways. You actually mention in your piece the lockdown, something that I had talked about in the early days of the lockdowns, pointing to the obvious fact that the alacrity with which the power structure moved towards this sort of risk-averse strategy was in part a reflection of their own high-risk status in their demographic. And I also want to talk about something else that you talk about in your writing, which is that in many ways, the interest in the sort of the plight of the working class is in some ways a projection of the anxieties of the professional classes who themselves see that they're going the direction of the working class. Anyway, I could go on and on, man. Neo-feudalism I've got here, the Great Awakening, this dichotomy between left and right, really, what is it, what isn't it? So much to talk about. I can't possibly tease it for the overtime. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Julius, as well as the transcripts and rundowns to this episode and every other episode we've ever done, head over to hiddenforces.io and check out our episode library or subscribe directly through our Patreon page at patreon.com/hiddenforces. There's also a link in the summary page to this episode with instructions on how to connect the overtime feed to your phone so that you can listen to these extra discussions just like you listen to the regular podcast. Julia, stick around. We're going to move the second part of our conversation into the subscriber overtime. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.